Hello, clients and friends. This is Robert Scott from Pre-Emptive Financial. It's our pleasure to bring to you an economic update as well as a year-end proactive tax planning workshop. This particular program is a little bit longer than normal, so you can play what you can listen to and then make a mark, and then you come back and finish it if you wish. So the thing that we want to bring out to you here is these things apply to the 2022 tax planning year. So we still have time to enact many of these ideas. The 5 key areas of financial planning are the same as always: preservation planning, retirement planning, tax planning, estate planning, and investment planning. So this is comprehensive, and that's what we do for our clients. We feel your education is the best thing that we can give you, because if you know how to handle knowledge and we can help you with that, then we can give informed decisions, and we feel that's the best. So equity markets are involved here. We're showing the 2022 economic outlook, and you can see from this chart that we've got January 2020 all the way up to November of 2022 listed here on this chart. So our strategy is long-term investing. So that's what we're going to explain here. Equity markets are showing 4 charts. What happens if I invest and look at 1 year like we had this year, down year so far? It looks pretty bad in the red. But if we look at a 5-year chart, we're very much up, even though we went high and then came down some. 10-year chart, less exaggerated, and the 40-year chart minimizes the whole downturn. Equities need to be a long-term investment approach. Our major concerns is inflation, interest rate changes from the Fed, recession concerns, geopolitical unrest, and we'll address all of those. So this could determine what happens to our equity markets in the future. So let's talk about inflation. September was 8.2 over the previous year. When we look back at history, 1970 and 80 had very high inflation rates. We're about halfway up the chart as far as what it is back then. We also saw a dip already, which is very good news. So we're expecting to see inflation slow down because of the Fed's involvement. Inflation hits us with energy, food, housing, and running our automobiles. We've all experienced these have gone up. So it's a good idea that our investments keep up with inflation rates. So keep up with those budgets that you have, and let me know about any changes that might affect you. And interest rates have gone up. The Federal Reserve met in November, raised the rates to 375 to 4. They went up 75 basis points, and we're expecting that rise again in December. The rate in December is expected to be about 0.5, half a percent. They are committed to combating inflation by increasing interest rates to slow the economy down. We have already seen the economy begin to slow down. So here you see the Fed funds rate over a 40, 50, 60-year period, and we are not at a high at all. So here's an example. In January 22, a 5-year was 0.36, now it's 4.3, and the 30 years 1.66 back in January, and now it's 4.15. We still have an inversion of our treasury yields. Of the 10-year and the 5-year are higher than they should be. So we're looking actually the 20-year as well. But that has adjusted down. The 20-year has adjusted down since this slide has been done. If you want to talk about how bonds could fit into your retirement income strategy, let me know. We have some very favorable bond yields at this time. The recession seems to be a concern, and Actually, we're in recession territory, but they haven't called a recession yet because there's more than one factor besides just the two downturns in quarterly GDP. But we do not think that there is a Great Depression or huge economic issue on the horizon. Next, we have geopolitical unrest, China and Taiwan. That tussle over sovereignty continues. Ukraine and Russia are still fighting over things. We continue to see this occur. What's the market outlook? So this is showing the history of the best fourth quarter markets. And you'll see that there at the fourth quarter chart, it's 3.9% is our average. We've had them as high as 78.6% of the time where it's gone up like that in the fourth quarter. So what are we hoping for that to happen? This is a quote from very important business investors, Warren Buffett. The stock market's a device for transferring money from the impatient to the patient. And then his business partner, Charlie Munger, said the same thing. It's waiting that helps you as an investor, and a lot of people just can't stand to wait. So please be patient. Remember, we're in it for the long haul. Here's another chart that will help you with perspective. This shows how long-term investing matters. We were 40-year to where we are today. You see how much it's gone up 20-year, how much it's gone up 10-year, how much it's gone up. All three time horizons show positive. But we have a caution. History doesn't tell the whole story. It's not indicative of future results. So we still believe caution is the principal notion for our investors. So the reminders for you, your risk tolerance or appetite needs to be in line with your investment. Your time horizon needs to be in line with your investment. Your behavior and your overall strategy should also be congruent. So these things are important because if we look at market volatility, sometimes it can create anxiety with stress that comes along with it. But if you know how you are investing and you feel secure in it, everything will be fine. Our overall strategy is important because the media is influencing us to be impulsive, to look at the negative, and they're not always telling us the thing that matters. Our main goal is to stay focused on your overall strategy. Caution is still the principal notion for investors. Inflation is still a catalyst for concern that goes up more, then interest rates will continue to rise. But if inflation starts to come down, which it appears to be doing, maybe they'll back off a little bit. Remember, we're in recession territory, but they haven't declared the recession. And the key to our strategy is long-term investing. We're here to help. So please don't hesitate to tap us on the shoulder and talk about your particular investment strategy. Caution is good, but we also have to be realistic about where we are in the timeline. Here's a thought about tax planning. We're at the end of the year, we're in November, so how can we do tax planning? We want to be proactive and not reactive. So the Inflation Reduction Act of 2022 changed some of the tax laws. It's adjusting corporate minimum taxes if they're over $1 billion to 15%. While these changes affect corporations, the personal suggestions or proposals have not really been enabled. And we feel that it really won't happen because it will be a difficulty to get things through Congress at this late date. So remember, we're not talking about preparation. Preparation is when you report, but planning is where you're proactive and adjust. Benjamin Franklin said, by failing to prepare, you're preparing to fail. So what we want to talk about is a strategy we can use right now. So these are the tax brackets. There's 7, 10, 12, 22, 24, 32, 35, 37. And they adjust according to our marital status, single, married, married separate, and household. This chart you can pause and look at if you need to. So when can we use our standard deduction versus the itemized deduction? So the standard deduction amounts for singles 12,950, for joint is 25,900. So these standard deduction amounts are much larger than they used to be. So the way we do a itemized deduction is we group them together. That's what this slide shows. We don't accelerate our deductions, but rather we time them or plan them and group them together. So we might pay our property taxes in December, and then the next year we pay them in January. And the point being that, or the next tax year, so that we can group the December payment into the 2022 if we want to itemize. But you have to look at the actual amounts to see if it's above the standard deduction. If it isn't, we push it out and we time it. Maybe we can group it together in 2023. Mortgage interest deduction limits have changed. These are significant because they affect state and local taxes, an acronym SALT. So if you have a mortgage that was taken out before 2017, you can deduct about $1 million of that mortgage debt over time. If you are doing your mortgage after 2017, it lowers it to 750, or if you're filing separately, 375. So these affect what you can do. So your tax preparer needs to look at all of this, and if you can do that ahead of time, that may help us. Remember, the SALT, the state and local income tax deductions remain at 10,000 as the limit. So we have to remember that is all we can do. So if you deduct your state and local income tax right now, 10,000 is the max. So it may not make sense to group them together next year if that's your only deduction. So what about our capital gains rates? Remember, this tax is not on IRA or Roth IRA money. This is on non-qualified money. That is money that is not a retirement account. So if you're single, 0 to 41 is 0. Married, it's 0 to 83. And if you're filing separately, 0 to 41, just like single. Head of household, 0 to 55. Those are the rates for 0. If we go over those rates, it jumps to 15. And if we go over these rates, it jumps to 20. Now remember, you might make 100,000, but your standard deduction if you're filing jointly is 25. That puts you at 75, which gives you a 0 taxable gain. So, or capital gain. So look at that very analytically. I think it'll really change the way you look at these things, and perhaps I can assist. So we have tax planning options. What are we talking about here? Capital gains can be used by harvesting losses, so we can offset capital gains. So if we sell at a loss, we can offset capital gains for things that we did at a positive. By harvesting these gains, this trades off the lower tax rate, and it's much better. If you go over a lot of losses, you can carry forward those losses to the next tax year until they're used up. But you can only use up $3,000 a year. So if you have really big losses, it might take a few years to get it all back. Okay, let's talk about retirement tools and the contribution limits that are there before the end of the year. So you want to fill up your retirement plan if at all possible. So if you're doing an IRA, it's 6,000. If you're over 50, it's 7,000. 401 is 20,500. If you're over 50, it's 27,000. If you've got a simple IRA, it's 14 and 17. And if you're doing a SEP, it's 25% of the match limit. And the percentage match limit is 20% if you're younger. So that allows you to defer up to 61,000. So the SEP plan does offer some pretty big benefits there if you're using those. Look at IRA Roth conversions very, very carefully. The benefit of Roth is it lowers your taxable income. It makes it so that long term you don't pay tax on anything in Roth. It's tax-free compounding. So the only time you pay tax is when you contribute, and then any growth comes to you tax-free. Very powerful. There's no required minimum distributions at age 72. So that allows you to keep it in there longer. And then if it goes to your beneficiaries, they get tax-free withdrawals, though there are RMDs on that money. So what are we looking at? We have to analyze the family tax bracket management. So what do we mean by that? This chart helps you to see. So if I'm the guy who's contributing or doing the Roth IRA, and I'm at a very high tax bracket, but my beneficiaries that are in a low tax bracket don't convert. It doesn't make any sense because you've got to pay the tax to convert up front. And if you're at a high tax bracket, you pay more. But if the kids inherited it, they have a lower tax bracket, it's better shape. If you have a lower tax bracket than your beneficiaries, by all means consider doing some Roth conversion. Another qualified program is 529. This allows you to save for college. Parents can do it, grandparents can do it. The tax exclusion amount is 16,000 per donee. So that means if the grandma wants to contribute to a child's 529, she can do 16. Grandpa can do 16 as well, giving the child 32,000. If you make this payment directly to a medical institution to pay for medical bills, it is not a gift. And if you make a payment directly to pay for tuition, it is not a gift. So that's actually a benefit to you. So what are the amounts of exemption from gift, estate, and generation skipping taxes? Currently, and for the next 3 years, it's 12.06 billion. In 26, it sunsets. We don't know exactly what it'll be, but it'll be about 6 million under current legislation. Generation skipping transfer is the same, 12.06, sunsets to 6, and estate taxes right now are 40%. So that means if you're over $12 million, pass away and give it to your family, then the amount over 12 million is taxed at 40%. And we have ways to help you manage that if you like. Qualified charitable distributions are still a good strategy. You have to be 70 and a half to do this. You can give a charity that's a qualified charity 100,000 from an IRA. Why in the world would I want to do that? You totally eliminate any taxation on that money that you're giving away. So if I've got 100,000 in an IRA and I choose to pull it out and then donate it, well, then my tax bracket is at least 12%. It could be higher. But if I do it with the qualified charitable distribution, the tax is 0. So it's a much wiser program. Let me know if you have any charities you would like to distribute some of your IRA money to. Remember, the RMD distributions were changed to 72, but the charitable distribution is still available starting at age 70 and a half. Tax proposals. These are not laws, these are proposals. Corporate tax they want to raise from 21 to 28. We're already in a non-competitive situation with many countries because of 21%. So 28 will put us at the high end of the corporate income tax scale, and that could move corporations offshore. Billionaire minimum tax is proposed, 20% minimum tax on those who have more than 100 million assets, and restrict deferral of gain for like-kind exchanges, Section 1031, which is a real estate transfer. I sell one property, I want to buy another one. They want to do away with that 1031 option. Why do they want to do that? They're interested in gathering more income tax. That's what it's all about. These are proposals. They haven't happened. What will happen in 23 or 24, we do not know. So what proactive tax planning can we do? We can manage our brackets. We can itemize our time, our itemizations. We can do gain and loss harvesting on non-qualified money. We can contribute to retirement plans, educational plans. We can give to charity. We can do estate tax planning. Remember, we're not just planning for the biggest wad of money, but we're planning so that you have money for major financial or life events. So please let us know of any personal situations that have concern. So what can you expect from me, from us? We're going to talk about regular review of changes that affect you, tax laws, investment laws. There'll be regular communication from us, as we've always done, through our newsletters and our personal visits. We'll have more frequent discussions as they're required. We're going to review the economic, tax, the estate, investment issues for you and give you a heads up if they affect you. Help us to help others. So please share. If you'd like to refer us, let us know. Our goal is to help as many people as we can. So let us know if you have a referral. You can call us or email us. We're happy to share that. And here's the fine print. Remember, we want to thank you because you've trusted us with your finances. We appreciate the opportunity to assist you. And number one for us is your health and your well-being. So keep that as your priority. And again, thank you for giving us the opportunity to assist you in all of your needs.